Good morning. It's Monday, the 18th of November, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. Indian businesses are seeing a cyclical downturn, as is quite evident from the slowing earnings for several companies, including consumer-facing ones. The question is, how long could this last? It turns out that it is becoming tougher to project that, mostly for two reasons. First, no one seemed to see this slowdown coming, or at least kept it a closely guarded secret if they did. Second, there was a clear post-COVID surge in spending evident in many parts of the world and, of course, in India. Now, how long will it be before the effects of this surge, reflecting higher than normal consumption, start to wear off and, more importantly, normalcy returns? The answer is not clear. Moreover, there are some surprising and even shocking insights from at least the automobile industry, which should hold out lessons for the rest of the economy. In August, Maruti Suzuki chairman R.C. Bhargava said that low cost and small cars were necessary for India's economic and social conditions and that a temporary setback, which is falling sales, would not change strategy. At that point in the financial year, Maruti's mini and compact segment sales had fallen about 12%, while utility vehicles were up over 16%. Indeed, for most of India's automotive industry, SUVs and premium cars have been doing well or better, even as dealers were staring at record inventories of over 80 days. Last week, Mr. Bhargava, in another interview to the Business Standard, this time sounded more grim. According to him, while gross domestic product or GDP growth is expected to be over 7% this year, the car market was not following suit. The pent-up demand for cars, he said, that emerged post-pandemic combined with supply constraints like the non-availability of semiconductors affecting production has now dissipated, he acknowledged, adding that they were seeing negative growth in the sub-10 lakh rupee car segment, which represents two-thirds of the market. Only the over 10 lakh rupee segment is growing, so overall growth is muted. So clearly a 7% growth rate cannot be sustained when one-third of the market is growing while two-thirds is shrinking, he said. The other reason, he says, for this is that higher safety standards have meant more expensive cars, and the load of those safety standards is more price-wise on smaller cars. As a Federation of Automotive Dealers Association India head told me a few months ago, incomes have just not kept pace with the rise in prices for small cars, which have gone up from about 6 lakh rupees to about 10 lakh rupees per car. The interesting point that the Maruti chief raises tangentially, of course, is that why GDP growth numbers, unlike before, are not running parallel or synced with car sales or other consumer product sales. Now, this, by the way, is something other consumer-facing industries are also pointing out, that they have seen a divergence between the overall economy growth numbers and their own growth numbers. Now, possibly this reflects the heavy weightage of government spending rather than private spending in GDP numbers. Possibly. Bhargava also suggests that this could be one reason why two-wheeler sales are doing well in recent years. People are not upgrading to cars as they would traditionally do, but upgrading within two-wheelers. Now, this is surprising because it means a behavioral shift caused either by prices or by some other factor like the attractiveness of the latest generation of two-wheelers. Because remember, until now, it was a fairly linear progression from two-wheelers to cars for most families in India. So when could demand return, particularly at that lower end? So this is the somewhat shocking part. Bhargava says growth will not exceed 3 to 4% for the next few years until economic growth helps bridge the affordability gap at the lower end of the market. He says that the 7 to 8% per annum growth will take a while to return. I do not know exactly how long. So what is Maruti or presumably other companies in a similar boat doing? Bhargava says since it's clear that the passenger car market in India will not grow very fast, we need to focus on exports. He says they are tapping into markets like South America, South Africa, West Asia and East Africa, among others. They're also starting with electric vehicles and see a good market in Europe. And the other interesting point is that few companies like Maruti or Suzuki make small internal combustion engines cars anywhere in the world now. So therefore, there is a market. The good news, on the other hand, is that Maruti's market is not the United States of America, where Trump's new tariff regime, as in when it kicks in next year, will hit exporting businesses world over. And that brings us to the top stories and themes of the day. The stock markets are weak. The Trump rally on Wall Street pauses. Gold prices are down almost 6,000 rupees from peak. Forex reserves are down about $29 billion from a September high of $704 billion. Tomato prices are down. Will they hold? And what does China plus one mean for India in the new Trump regime?
This is a Core Report with Govindraj Ethiraj.
Wall Street pauses. Will India pick up? Before we get to what happened in the stock markets, let's get the important news out of the way that it will be a holiday-shortened trading week this week. Now, that's because of assembly elections in Maharashtra on the 20th of November. That's Wednesday for the 288-member state legislative assembly. And I will be going out and voting, as I hope you will be too, particularly if you live in the state of Maharashtra and maybe in the city of Mumbai. Back to the markets on Thursday, November 14th, the BSE Sensex fell about 110 points. Remember, Friday was a holiday too, and closed at 77,580, while the NSE Nifty 50 fell about 26 points to end at 23,532. So the benchmarks lost about 2.5% last week and marked the sixth weekly loss in 7 weeks, according to Reuters, pointing to worries about a slowdown in consumption, adding to concerns over earnings moderation and foreign outflows. The Nifty 50 has closed below its 200-day moving average for the first time since April 2023, according to Reuters. So could we pick up some cues from Wall Street? Well, I'm not sure about that because Wall Street and the Wall Street have diverged in recent months, but it's worth noting that the Trump victory rally has finally paused and investors are now looking at interest rates. The Dow Jones Industrial Average lost about 305 points to end at 43,444. The S&P 500 and the Nasdaq Composite all fell between 1.5% to 2.5%. President-elect Donald Trump said on Thursday that he planned to nominate vaccine skeptic Robert F. Kennedy Jr. to lead the U.S. Department of Health and Human Services, which of course sent pharma stocks tumbling, according to CNBC. The IT sector of the S&P 500 was actually the worst performing corner of the market, down more than 2% as Nvidia, Meta, Alphabet, and Microsoft all fell. Tesla was a rare exception in that shares of the electric vehicle giant and the so-called Trump trade were higher by 3%. Now, that's not clear to me how Tesla benefits because Trump, at least in the past, has been anti-electric vehicles and green technology, unless this means that Tesla will get a free pass and others may not. But that also brings things back to a somewhat current situation, would it not? Oil prices soften America's new energy man. Sticking to energy, oil prices are now holding at around $71 a barrel, surely on the softer side. Meanwhile, President-elect Donald Trump nominated Chris Wright, who runs a Colorado-based oil and natural gas fracking service company, to lead the energy department. Wright is CEO of Liberty Energy and has no previous Washington experience, and according to Bloomberg, has made a name for himself as a vocal proponent of oil and gas, saying fossil fuels are crucial for spreading prosperity and lifting people from poverty. The threat of global warming, he has said, is exaggerated. On the other hand, it's not like companies like Liberty Energy are strangers to ESG or environmental, social, and governance practices. I visited the Liberty Energy website just to check what they claim they're doing. Nothing dramatic except, of course, making production of shale oil more efficient using technology and tools like electric and natural gas-powered engines for frac fleets, or hydraulic fracturing or fracking to extract oil and gas from rock into which high-pressure water and sand is injected. Liberty says it transports sand more efficiently. Now, I'm not sure if any of this moves any needle, but shale gas production has made America the largest oil producer in the world with an over 22% share, while Saudi Arabia is next at 11%. Yes, you may have thought it was the other way around. So more drilling in America will surely mean lower prices, which is great for countries like India, who are also importing from America, by the way. But it's not clear how that helps the producer countries themselves beyond a certain point, because they have to or would try to keep prices higher, as the Organization of Petroleum Exporting Countries, or OPEC Plus, usually does. Gold prices are falling. Gold prices on Friday were on track for their biggest weekly decline in over 3 years, as expectations of less aggressive interest rate cuts by the US Federal Reserve lifted the dollar, making bullion less attractive, according to Reuters. Gold lost slightly to about $2,565 per ounce, and prices have fallen more than 4% last week, touching their lowest since September 12th. In India, physical gold premiums have climbed to a near 4-month high thanks to a rebound in demand as prices dropped, while top consumer China saw limited retail buying interest, said Reuters. Earlier last week, again, domestic prices in India were down to 73,300 rupees per 10 gram after hitting a record high of about 79,000 rupees, 775 last month. That, of course, turned on Thursday, and prices were up to about 77,000 per 10 grams in the national capital, and subdued demand trends in the global markets, according to the All India Sarafa Association, quoted by Reuters. The markets, of course, turned on Thursday, and prices were up to about 77,050 per 10 grams in the national capital, thanks also to subdued demand trends in the global markets, according to the All India Sarafa Association, quoted by Business Standard. The precious metal closed at about 77,750, and this was after falling marginally on Wednesday. Silver, by the way, has also fallen to about 2,310 rupees to about 90,190 per kilogram. And before we continue, a short break. From transforming healthcare to reshaping customer service, AI or artificial intelligence is making a tangible impact across industries. How is artificial intelligence augmenting human capabilities and driving real-world outcomes? And what does this mean for businesses in India? How can India leverage AI responsibly to stay ahead globally? In the latest episode of NASCOM Conversations, I was joined by Srikanth Velamakkanni, co-founder and group chief executive of Fractal Analytics, who answers these questions and much more. You can find a link to this episode in the description. And now, back to the show. The rupee is still weak. The rupee is now holding at a record low of about 84 rupees 39 paise to a dollar, even as India's foreign exchange reserves have dropped for the sixth consecutive week to a near 3-month low of $675 billion as of November 8th, according to data from the Reserve Bank of India on Friday, quoted by Reuters. The reserves fell by about $6.5 billion in the reporting week and are down about $29 billion from the record high of $705 billion hit in late September, Reuters said. Now, this is obviously because of the central bank's intervention in the Forex market, as well as the appreciation or depreciation of foreign assets held in reserves. So you can imagine where the dollar could be if there was no buying by the Reserve Bank. Tomato prices are down. Meanwhile, prices of tomatoes, a key villain in the recent spike in food inflation and overall consumer price inflation, have declined. Food inflation was up about 42% last month. The government's Consumer Affairs Ministry said retail tomato prices declined about 22% month on month to an average retail price of 52 rupees per kg on November 14th, as opposed to 67.50 per kg on October 14th. Now, this, of course, may mean little depending on where you are in the country. It's possible it may align to the lower price or it may not. Prices of tomatoes are, of course, volatile, and there is little or no way to project prices, as economists have been asking and have been telling me, because production is at the mercy of changing weather patterns, which are unpredictable, and if farmers are incentivized at that point to plant tomatoes. On the other hand, distribution is at the mercy of weak supply chains, all of which affects prices. Projecting Trump's tariff regime and its impact on Asia. Asian economies are in the middle of a major economic transformation, and there are more factors shaping the economic outlook than we can count on our fingertips. Priyanka Kishore, director and principal economist of Asia Decoded, a Singapore-based research firm, told me. Key amongst these driving factors is Trump 2.0, global tariffs, and supply chain diversification. I reached out to Priyanka and I began by asking her how she was seeing the likely post-Trump world evolve, particularly from her vantage point, which encompasses not just India but all of Asia.
Clearly, he is looking to deliver on his campaign pledges and converting them into policies, as you can see from his cabinet selection, which is pretty hawkish on China. And so the threat of tariffs, which from this region's perspective, Asia's perspective, is, probably the top concern at this point of time, is pretty large. And to, see why it is so widespread and applicable almost to everyone, I'm going to talk through 3 criteria. The first and topmost, of course, is, do you have a surplus or a deficit with the US? And barring Singapore, every country in this part of the world has a surplus with the US. Of course, China, the largest, Vietnam following that, but really no one here is running a deficit other than Singapore. But then, the second criteria, are they only going to look at overall trade balances, or they go a step further and they are also going to look at sectoral trade balances? Singapore does not have a sectoral deficit with US in every category. It runs a surplus in pharmaceutical products. So, the first criteria might be, necessary. It's not sufficient to exempt you. So therein comes the second. And then the third, where, they also look at, someone might say, but then, some of these are your strategic partners. Why don't you exempt them? But then they're going to say, are they backdoors for entry for China into US goods? And they start looking at how much you're importing from China and compare it to how much you're exporting to the US. Vietnam gets struck down immediately on this metric. It's got like a share of 34%, 35% imports from China. Also, most of ASEAN and India too is importing more and more from China. So in short, I think the point I'm making is that the entire region is in the firing line as far as the tariffs are concerned. Of course, it remains open to debate whether he's going to implement 60% on all goods from China, then 10 to 20% on everything across the region, then I think that is impractical from the US perspective, their economy perspective. So eventually it might end up being targeted. So from China is things like advanced exports, clean tech exports that are more at risk. Probably FMCGs, consumer goods will see a lower tariff rate being applied. Similarly, it will be more targeted for the rest of a region, but it's pretty unpredictable. And this is going to cause a lot of uncertainty for businesses for the time being.
And you're saying that if, for example, countries like India, which also import from China and then manufacture here, classic case being Foxconn supplying to Apple, and then after having assembled those components, it becomes an iPhone and then it goes to the United States. So would the US target those kind of imports as well in terms of duty levels?
See, as I said, with the Trump, we don't know. They definitely, going to try to push and say that, find different suppliers. They could start from that point. They could probably say, not target Apple to begin with, but they could target something else. So for the risk for India is that, we export a lot of labor intensive products to the US. In the first term of Trump, we lost preferential access on things like textiles. These are going to have a bigger knock-on effect on domestic demand if gems and jewelry and textiles get hit by tariffs. If it doesn't hit iPhones because that's an Apple company, but hits something else, you will see an outsized impact on domestic demand in India compared to their export share.
So you're saying that if it's an American company like Apple, which is importing back into the United States, and there could be many other examples, you're saying they may not be as badly affected as a pure Chinese company, for example, or an Indian company which is exporting its product from here.
I think so. At least to begin with, they will try to persuade American businesses to onshore. They're saying that. But there's a real challenge in doing that. You cannot bring back businesses just with tax cuts. There is a resource scarcity in the US, as we can very well see from TSMC, which is trying to build a chips factory, but is facing semiconductor engineers shortages. So there are practical challenges to onshoring. So while they work that out, they might go easier on their own companies, but it puts the country as a whole, in some sort of firing line.
Because, I would think that many Indian companies who export to the US are actually exporting to American companies. So whether, for example, in apparel or textiles, it could be a Gap or an Old Navy, or obviously it could be Walmart and some of these bigger chains. So these are essentially American companies. Okay, let me come to the other point. China plus one has been a big theme for countries like India. It's worked to some point and it's also not worked. So how are you seeing that?
So China plus point is an important mitigating factor for the region. It's going to continue because it's driven by some very fundamental factors which were in play even before the US-China trade war. So, for example, rise in labor costs in China that was leading to factories migrating out of China to Vietnam even before, from 2010. Then, of course, there is supply chain risks have brought into focus that geographical concentration has various challenges associated with it. So businesses want to diversify irrespective of the US-China trade war. That will continue. This adds a complication because if the US is going to inspect very closely that what are the rules of origins of the goods that you're exporting to the US, where are they coming from? How much of it is, China linked? It might slow down the process in certain sectors. But then again, I think opportunities are also there because the Trump is a self-proclaimed climate skeptic. So they probably step back in green supply chains. And there, India and ASEAN, who want to, increase their market share in these supply chains, get a bigger opportunity to broaden their footprint. And maybe there they are not then so worried. Where are you importing the inputs from? So overall, I think the trend will continue. Countries have to be smart and spot the opportunities because they are dealing with a very unpredictable administration.
So you've talked about this in your Substack series, which you are still rolling out, as I can see. And you've talked about these 5 themes for Asia in 2025, which also reminds me that I should come back to you closer to 2025. But at this point of time, you're seeing that the region itself is going to take some shocks.
Yes, it's not only the US, China, and Trump too, right? China itself is slowing down. The region is pretty linked to China, not so much India, but ASEAN and other parts of the region. China is a pretty dominant export destination. Even though the reliance has come down over the years, it matters a lot. So there's that feeding through. We have consumers probably turning cautious, and that's a big shift that's going to happen from 2024, where consumer was pretty resilient. And the reason for that is, of course, as exports slow down, you have the spillover impact on the domestic industries. Unemployment could rise. People will be looking out and consumer confidence will take a hit. So you have a cautious consumer, which means domestic demand buffer might be a little less. I don't want to sound too negative because we also have, the capacity to cut rates. And sooner or later, most Asian central banks will join this cycle because while Trump policies are inflationary for the US, they're disinflationary for the rest of the world because they will bring growth down. Probably oil and other commodity prices come down in tandem. And as you import cheaper Chinese goods, there is an additionally disinflationary factor playing out here. So that's there. Now, central banks will have to balance this fine thing of weaker currencies versus growth coming down. What are they going to prioritize? I think given the FX reserves that exist in the region, we will see rate cuts that will buffer consumption, will support consumption to some degree. So the slowdown will be not falling off the cliff, and they will deploy their FX reserves to manage currency weakness.
Priyanka, thank you so much for joining me.
Pleasure to be here.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.